Most traders go long with a call option when they're bullish, but here's the truth. Most of those trades expire worthless. The zebra strategy flips the script, giving you stock-like upside and profits from the very first uptick. Zebra sounds like something you'd see on a safari, but here it's trader slang. It stands for zero extrinsic back ratio. And yes, we're just going to call it zebra because that's way cooler. The zebra is a stock replacement strategy with defined risk. It acts like owning 100 shares and delivers dollar-for-dollar movement with the underlying stock. You'll often start making money from the very first price shift. Plus, the chart comes with a built-in stop loss. So from day one, you know exactly how much you could lose. Here's how it works. Buy 2 deep in the money calls, sell 1 at the money call, all with the same expiration. With a zebra, we aim to sell an option that covers most of the time value in the ones we buy. This removes much of the excess premium from the trade and keeps your break-even close to the current price. That means you can often start profiting from the very first upward move instead of waiting for a big rally. And in a minute, we'll show you a real example where a zebra beat a long call on cost, risk, and break-even by a mile. Most traders trying to go long buy a call option. It's cheap, but unless the stock moves far enough to cover the premium, you make nothing. With a zebra, the break-even is much closer to the current price, so you can start profiting sooner, even if your max loss is a bit higher than a single call. That's the trade-off, and it fixes the biggest weakness of a plain long call. Let's compare zebra to a standard long call, point by point. First, upfront cost. A long call is cheap, and you only pay the premium, so it's low. A zebra costs more because you're buying 2 deep in the money calls and selling 1 at of the money call. That puts it in the medium range. Still far cheaper than buying the stock outright, but with more skin in the game than a single call. Next, max loss. With a long call, your worst-case loss is the premium you paid. With a zebra, your loss is similar and capped at the net debit, the amount you put in when you opened the trade. So you know your maximum risk from the start, and it's usually just a fraction of the stock's price. Upside potential? Both have unlimited upside. If the stock takes off, you're right there for the ride. No cap on your gains. Here's a big one, break even. With a long call, the stock has to move far enough to cover both the strike price and the premium you paid, often a long way from where it's trading now. The zebra, because the sold call offsets most of the time value in the bought calls, can have a break even much closer to the current price. That means you can start making money with a much smaller move. Finally, who is it for? A long call is best for pure speculation. You're betting on a big move. The zebra works as a risk-defined stock replacement. You get stock-like upside with a built-in stop loss, so it's a smart choice when you want to go long without tying up full share capital or risking a big drawdown. Alright, now that you know who the zebra is built for, let's weigh the trade. On the plus side, you get a break-even that's often right near the current price, meaning you can start profiting from small moves. You've also got the same upside potential as owning shares. Without the unlimited downside, your loss is capped at the amount you paid for the trade. But there are trade-offs. This is still a debit strategy, so it costs money to enter and will lose a bit of value each day from time decay. And while your loss is capped, a big drop in the stock can still take you all the way down to that maximum loss. So it's defined risk, but not risk-free. Many traders wonder, once you've put a zebra trade on, how do you manage it? Let's break it down. First, protection. Since the zebra is a debit strategy with a capped loss, you don't need to add protective options. If the trade moves against you and you're in the red, you can simply close it and re-enter later at a better strike, or when the setup looks stronger. If the stock moves in your favor, you don't just have to sit there, you can manage the position to lock in gains and still keep your upside. Here's our original zebra. 2 green balls at point A, $220, representing the 2 calls you bought, and 1 red ball at point B, $250, representing the call you sold. The right side of the curve is your stock-like upside, the left side is your built-in stop loss. Now, let's say the stock rallies from $250 up toward $300. Your profit point climbs along this slope, exactly what you want. And here's where you can take action. You roll one of those $220 calls up to a higher strike, say $300. If the stock makes a strong move higher, you can roll one of your deep in the money calls up to a higher strike, for example, from $220 to $300. This locks in part of your gains, while still keeping exposure equal to 100 shares. And if the rally continues, your upside remains unlimited. Here's what that roll achieves. First, you lock in part of your profit. Second, you still control the upside equivalent to 100 shares. And third, if the stock keeps climbing, your gains are still unlimited. Just keep in mind, rolling isn't free. That new call you buy can still have extrinsic value, so you might need to put some of your profits back into the trade. But since you are taking some of the profits home, it might be worth it. Now that we understand what the Zebra strategy is and how to manage the trades, let's see how to find these trades on the Samurai platform. But before that, if strategies like this help your trading, please like this video and make sure you subscribe so you don't miss the next one. Let's build a Zebra scan on Option Samurai. First, go to Custom. Add 2 option legs. The first one is buying 2 calls, and the second is selling 1 call. Next, add the break-even percent filter by simply searching our extensive list of filters. Set it between -3 and +3%, so the trade starts profiting close to the current price. You can also look up the max loss filter, which you can then use to limit the maximum loss to below $500. Click Run Scan, let the results load, and there you have it. A list of Zebra setups ready for you to evaluate. Just click on any trade to dive into the details. To try it yourself, head over to Options Samurai and build your scan. Samurai scans millions of options in seconds. Sign up for a 14 days free trial. Options Samurai. Find your edge now. And if you're serious about improving your options trading, click this video to take the next step.